US dollar to Japanese yen just printed a fresh multi-decade high at 161.50, and at the exact same moment, Japan has come out and said they will act any time to defend the yen. This is not a drill. The price is now sitting inside the intervention kill zone, and every trader watching this is asking the same question. Are we about to see a 300 pip freefall, or is this the start of a melt-up that punishes every single short? Right now, there is one danger zone and one hidden opportunity, and I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, including the number that separates a catastrophic collapse from a historic breakout. Let's get straight to the instant market verdict. The overall trend across every time frame, monthly, weekly, daily, and even the 1 hour, is a strong buy. The ADX is sitting at 51.5, which tells you this is not just a trending market, it is a trend on steroids. But the immediate session bias is not a simple buy. With Japan's verbal intervention the dominant macro force right now, and price stalling exactly at the 161.50 resistance cluster, the next few hours are a high-stakes tug-of-war between momentum and policy fear. My bias is that we see an intraday fade from these extremes, a sharp, intervention-scare dip, before the trend resumes. The single invalidation level that flips everything is 161.60 on a daily close. Write this number down. If we close above 161.60 today, the intervention narrative gets completely steamrolled, the short squeeze engine ignites, and we target 163.00 and beyond. On the other hand, if we fail here and start losing 160.80, the intervention ghost becomes very real. Here is the micro insight that matters. The herd is positioned heavily long, with retail sentiment running at extreme bullish levels. That positioning is dry tinder. A single headline, a sudden MOF comment, can trigger a liquidation cascade that sends this pair down 100 pips in minutes. That's exactly why we need a plan. Now let's go technical, from the top down, so you see the full architecture. On the weekly chart, this is a powerhouse. Price is miles above every major moving average. The 200-week moving average is way down at levels we haven't seen in years, but the more immediate reference is the daily structure. The daily MA20 is at 159.97, the MA50 at 159.21, the MA100 at 158.25, and the 200-day moving average is resting at 156.36. All of these are sloping higher like a stack of upward vectors. When you have this alignment, dips to those moving averages are gifts in a trend, but we are nowhere near them. The price is trading over 200 pips above the 200-day MA, which tells you the extension is real. RSI on the daily is at 68.6, not yet overbought, so there is still room on the oscillator, but the commodity channel index on the shorter timeframes is screaming. CCI is at 285, deeply overbought. That warns of an imminent snapback. Drop down to the 4-hour chart, and here is what most traders miss. We have a textbook bearish divergence brewing. Price carved a higher high above 161.20, but the MACD histogram is printing lower highs. Buyers are exhausted. That negative divergence is exactly the kind of signal that precedes a sharp mean reversion move, especially when an intervention threat is hanging over the market. On the 1-hour chart, we see price hugging the upper band, with the 5-period and 10-period moving averages, the MA5 at 160.74 and MA10 at 160.44, curling up but losing gradient. The pivot point today is 160.77, and that is the hinge. Above it, the immediate resistance is 160.90, then 161.20, and the critical ceiling is a 3 at 161.59. Price right now at 161.45 is kissing the top of this resistance zone. If we get a rejection here and a 1-hour close back below 161.20, I expect a rapid slide toward the first support at 160.21. Below that, S2 at 159.82 becomes the bear target, and that's also where the 20-day moving average sits, 159.97, so you have a confluence. The deeper support is 159.52. So the structure is crystal clear. Above 161.60, the intervention fear evaporates and momentum traders pile in for a melt-up. Below 160.77, the intervention ghost starts to bite, and we could see a freefall that tests the 160.21 support within hours. This is the roadmap. Now let's connect this to the fundamental driver that is fueling every tick right now. Yesterday, Japan's top currency diplomat stepped forward and said Japan will act any time against excessive yen moves. That is classic pre-intervention theater, the same language they used before the massive yen buying operations of 2022. But here is the twist that most commentary misses. The US-Japan 10-year yield spread just widened to a new cycle high, above 350 basis points. That yield differential is rocket fuel for the carry trade. As long as the Fed stays hawkish and the BOJ remains pinned, every dip in US dollar to Japanese yen gets bought aggressively by yield-seeking capital. The Bank of Japan is trapped. They cannot hike aggressively without crushing their own economy. Yet their verbal warnings lose credibility the more price rises. This creates a volatile loop. Intervention threats cause sharp intraday sell-offs, but the underlying yield differential pulls price right back up. The 1 to 2 week directional lean is cautiously bullish, but with a fat tail risk. If Japan conducts actual physical intervention, we could see a 300 pip flash crash toward the 158.00 area. The exact event that invalidates the bullish lean is a daily close below 159.50. That would signal a structural shift. So right now, we are riding the trend but with our eyes glued to Tokyo. Before I give you the trade setups, here is your first interaction trigger. Do you think the dollar breaks 105 against the yen this week? That's not a typo, I mean 105 on the dollar index, but for US dollar to Japanese yen, the question is, does it hit 163 before a 200 pip collapse? Comment 163 or collapse right now. I'm tracking. Consensus, and I want to see where you stand. Now, most people skip this section. That's exactly where the money is made. Keep watching, because I'm about to hand you 3 precise strategies. Write these numbers down. Strategy 1, the sniper. This is the conservative play for traders who want to buy the trend but refuse to chase at the intervention high. You are going to wait for the intervention scare to do its work. The trigger condition is a limit order at 160.25. That's just above S1 at 160.21, with confirmation on a 1-hour bullish engulfing candle that closes back above 160.50. The stop loss goes at 159.80, which is 2 pips below S2, giving you about 45 pips of risk. The logic is simple. If the intervention dip loses that support, the free fall could accelerate and you don't want to be in the way. Take profit 1 is 161.40, right where the prior consolidation sits, and take profit 2 is 161.90, a breakout target above the R3 ceiling. This gives you a risk-reward ratio of roughly 1 to 2.5. What voids this setup entirely? A 4-hour candle close below 159.50. If you see that, the buy thesis is dead. The sniper, conservative, entry, 160.25, limit, with 1H close above 160.50, stop loss, 159.80 take profit 1, 161.40 take profit 2, 161.90 risk, reward, 1:2.5 are invalidation. Void if 4H candle closes below 159.50. Strategy 2, the active trader. This is the standard mean reversion entry for those who want to trade the rhythm of intervention headlines. You enter on a pullback to the daily pivot point at 160.80, but only after you see a clear rejection wick on the 30-minute chart and a swift bounce. Stop loss goes at 160.40, which is below the hourly MA5 and the round number support. Reason: if the pivot fails to hold, we are sliding to 160.21, and you don't want to be long through that. Take profit 1 is 161.50, right into the resistance cluster, and take profit 2 is 162.00, a level that would confirm the melt-up. Once TP1 is hit, immediately move your stop to break-even and trail it by 20 pips. The setup is voided if we get a 1-hour close below 160.20, That signals the intervention jitters are overpowering the trend. The active trader, standard, entry, 160.80, pullback to pivot, with 30M bullish rejection, stop loss, 160.40 take profit 1, 161.50 take profit 2, 162.00 trail, move stop to break even after TP1, trail by 20 pips invalidation, 1H close below 160.20 now. Before I give you the aggressive play, I want you to type your US dollar to Japanese yen range for tomorrow in the comments right now. Give me a high and a low. Let's see who's aligned with the levels I just mapped out. Strategy 3, the aggressor. This is the high-risk, counter-trend short that trades the intervention ghost. You are betting that the verbal warnings turn into a genuine intraday panic. Entry is at 161.55, just inside the R3 resistance at 161.59, with a very tight stop loss at 161.75. That's only 20 pips of risk, and it must be respected without hesitation. The target is a rapid drop to 160.50 first, then 160.00, capturing a potential 100 pip liquidation spike. Risk-reward on this is 1 to 5 if it works, but let me be absolutely clear. This is a trade against a raging bull trend, and it only makes sense if you can lose small and manage risk aggressively. Invalidation is a 30-minute close above 161.65. If price breaks through that and holds, the intervention threat is dead for the session and you exit instantly. The aggressor, high risk, entry, 161.55, limit, short, stop loss, 161.75 take profit 1, 160.50 take profit 2, 160.00 risk. Reward, 1:5 are target invalidation, 30M close above 161.65, exit immediately. Risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like BOJ statements or US yield spikes. Stops are non-negotiable. A single intervention headline can gap 20 pips past your stop if you're not disciplined. This is how you survive to trade the next explosive move. Now let's lock in your plan and look ahead. The single most critical level for the next session is 161.60. A daily close above that and we are in melt-up territory. The intervention ghost gets buried, and we target 163. A rejection and a break below 160.77 flips the intraday momentum bearish and opens a fast move to 160.21. Tomorrow's focus is the Bank of Japan's routine bond operation and any further verbal escalation from Tokyo, plus the US PCE data that could shift yield differentials instantly. That's the wildcard that either validates the breakout or triggers the freefall. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen and I'll walk you through the liquidity grab that nobody sees coming. Smash like if this gave you a clear plan, subscribe, hit the bell, and I'll see you in the next one.